up here in North Iowa.
Oh, we're live.
We are live. Welcome, everybody, to another episode of Ask Me Anything. We've got a full crew here. I think we're going to be short, Chris and Steven today. I think we're doing something right, Shauna?
Are you calling Chris short? That's not very nice.
Oh, I'm not going there. But welcome, everybody. We're going to go ahead and play a little clip, and then we'll go around the horn, introduce ourselves, and get those questions into the chat. All right, welcome everybody. Hopefully we got some new people here. If you guys are new to this, Ask Me Anything. So this is where we answer any questions on wealth, on infinite banking, on, well, not really politics, but pretty much anything you can ask. So go ahead and get those chat or the comments in the chat box, and we'll go around the horn. So I'm at Brian Fouts. I'm up here in North Idaho getting ready for the winter, and it is cold, and I don't like it. It's not bad up here, but yeah, having a lot of interesting calls. We actually had a Puerto Rico client today, which is very rare. So that was kind of fun to have someone from Puerto Rico, which we can do policies even there. So with that, though, I'll go over to Shauna.
Hi guys, my name's Shauna. I'm up here in Western New York with Joe and Chris. Been doing infinite banking for 6 years now, so I practice it and I love it across my 3 policies. I'm finally in those efficiency periods and really loving that. And I love, hearing all your questions because I learned so much through all the questions that you ask. So ask away, and I'll pass it over to Linus.
Hey, it's the big beard banker from Hopkinsville, Kentucky. My name's Linus. Do you?
I do.
Up with it. So, it looks like Jake Doster there in the comments is saying he watched my interview with Jesse Durham. That was 2 years ago, I think. It's been a little while. Today, we've had rain for 3 days in a row, so it's a dreary, drizzly day out here in the bluegrass. But having fun, helping lots of people understand and start infinite banking on themselves. Tess, go ahead. Let's hear from you.
Hey, I'm Tess. I'm in Michigan, and yes, we're a little colder now too. I had to pull out the flannel today. I walk my mother at 5 a.m. every morning, and we were in the low 40s today. But she's a trooper. She hasn't given up. Insurance has been my life since I started my career, and it's a great place to continue to be now. So looking forward to what you guys have to say today. And now it's over to Mr. Kovacevic.
Hello, thank you, Tess. Well, I'm going to make Jason cringe a little bit. So today I wore shorts and a short sleeve t-shirt. Started off at 36 degrees this morning, but we got up to a balmy 55. So we have blue skies and green grass still, and I'm still enjoying it because I really don't like the white stuff. But I'm stuck here for another 3 years until Ariana gets out of school, and then I don't know where I'm going to go, but it won't be with snow. And off to brother Jason.
Thank you, Mr. Helock, Mr. Kovacevic. Look at that, Joe. It can be done, even live. So it was a balmy 62 here in the City Beautiful this morning. I just went in the plunge because I thought all of you cold people needed some company with being freezing. So I went in the plunge. There's a couple of lizards I'm going to post. We're hoping they come back to life. Not sure they made it, but we're seeing since they're reptilian, So we're hoping for the lizards. Everybody, a little prayer. All right, but I'm looking forward to all your questions. Ask us any question you want, and we will do our best to answer them. Over to Mr. Yenny.
All right, good afternoon. Craig Yenny here, and I hail from the south of Denver, Colorado. Nobody wants to live here. It's cold. It's horrible. It's not a good place to be. Don't even consider coming here. And I know Shane, I see you on here. You're probably with me, man. It's really cold. It was 17 degrees this morning.
Yeah.
But anyway, I am one of those weird people that like the cold, bring on the snow, give me the cold. I like it. Go out snowshoe. I'll go play in the snow. But I don't really like the hot weather. I think I was a polar bear at one point in history. But anyway, we'll leave it at that.
Well, so, then the Yeti makes sense then.
It does make sense. And like you said, you got in the cold plunge. I was doing cold showers every day for the longest time. And today I started back up. I'm like, Yeah. 2 minutes of just a cold shower. Feels so good.
I played in the snow for 20 years outside with the railroad. That was enough playing that I need to.
I could see that. I could see that. I go out there when I want to go out there, not when I have to.
Yeah, there's a big difference, brother.
Yeah. I get you on that one.
I don't know, Jason, maybe you can agree, but before I did cold plunges, I tried the cold shower, and I actually think taking a cold shower is harder and worse, like, than jumping in the cold. I feel like the cold plunge is easier to accomplish.
I think it can be so. Yeah, it's a perception thing too, like mindset. Like Patty imagines this. For everyone who does cold showers, Patty imagines, oh, this is liquid gold running all over my body, repairing all of my cells, and she makes it this really cool sounding thing. I'm like, it just sucks when I do it. I don't know. Same with getting in the plunge. She said, I didn't hear you yell today. I'm like, yeah, it's because my friend's here and I didn't want to be a wuss getting in. So I quiet. So
maybe you could have her guide you in the shower and tell you what to think.
that's a good idea. Have Patty guide me in the shower.
I don't know about all you guys out there, but I'm on the other side of the spectrum. I think one of the best joys in life is a nice hot shower. So I don't know why you would ever want to take that away. You know, that's what I'm saying. So I'm sticking with it.
All right. Well, let's get on with it. Are there any questions out there, Brian?
There's going to be some questions.
Oh yeah, Shauna, do you want to be the reading?
I'll start from the top. So Shane is saying, Craig mentioned his policy goes up in available cash value daily. Is that from the guarantees and the dividends are paid out in one lump sum at the anniversary date of the policy?
Yes, that is correct. So just the guaranteed portion of the policy, you'll see the cash value going up every day. Death benefit goes up every day. And then at that policy anniversary, after you make your first, you make that monthly or that annual payment, then the dividend gets created. So for the last 3 days, and this is something that I've been looking at, I used to do this years ago. In one of my policies, it grew $47.09 2 days ago in cash value. And then today, I went back and looked and did the math from today to yesterday, and it grew $62.47. So I'm like, it's definitely not linear, but it's just kind of fun to see the growth with the death benefit. It's interesting because the cash value went up $62, but the death benefit only went up $17. Anyway, fun stuff.
Well, PUA cash, PUA death benefit goes up slower than probably the cash value, I imagine, or something like that. Like it's not a one-to-one, right, relationship. So
It definitely is not a one-to-one. So it's just kind of fun to watch it. But yeah, that's what's going on is the guaranteed. What we're seeing is the guaranteed growth every day.
And I'm excited for Shane. I mean, he already loves this stuff so much. Can you imagine now he knows that it's actually the guarantee is a cumulative guarantee and it actually gets better every single day. That's not hyperbole. That's not us making stuff up. It actually gets better every single day and always will as long as you hold on to that contract.
I love it. All right. Joe Watkins is saying, how do I get started with infinite banking?
Knowledge. First is learn about it. That's the first thing. So you're in the right spot here. Check out the YouTube channel. Just keep learning about it, because I had a lot of people that ask me this question. Oh, I want to do this, but they don't have any knowledge and no foundation of knowledge. And so when you go and talk to a infinite banking practitioner, how do you know that what they're doing for you is going to make sense for you? You don't. So knowledge is what's going to allow you to understand how infinite banking makes sense to you. That's so to me, it always starts with knowledge, and then obviously working with the right person that can set it up for you correctly. So
I love it. I'm actually going to put 2 videos in the chat that I was looking at earlier. And I kind of suggest watching them one after the other. It's not our 90-minute by any means. We always kind of say, watch this 90-minute video. But there was 2 videos I found really interesting. It was, like a 25-minute video from Chris on how to be the bank just by changing one thing. And then the next video, I think, came out yesterday. And it was where he breaks down like how it adapts with you as you grow and the policy grows and like the different life stages. So I'm going to put both of those in the chat. And then also I put our once you have that knowledge, for anybody, maybe you feel you already have that knowledge and you want to get started, you can book a call with our team at mentors.beyourownbanker.com. And all right. And then Christian O'Mara is saying, HELOC Joe, I need to make another appointment for our second call. Can you reach out?
Yeah.
We can do that.
Does he need to? Is what he's asking. Does he need to?
Oh yeah. Do I need to?
You can always call me. We'll chat. That's okay.
Okay. You sure?
Sure.
Okay. Penny Lover is saying, question, my husband and I both have policies. We have about 35,000 we can use. We got a lump sum from retirement and sold a house. We have a lot of debt. We're frauded, investment loss, carrying costs. We have a mortgage. We currently don't have income. We are scared to use a lump sum to pay all debt, but are unsure how to use policy.
So I guess the first question there is, if you don't have income, how are you maintaining your expenses and bills and all that? Because I mean, even before you consider infinite banking, I mean, income to me would be priority number one. Without income, you have nothing to work with. I mean, yes, you have to lump sum, but I'm assuming you're burning through that. So this raises a lot of questions.
I had a lot of questions. I was like, is the 35,000 in cash value like that? Is that already in the policy? Is that something that you received, from retirement, like you just said, or selling the house? Just kind of wondering where that's sitting and what you're intending on doing with it. So it's going to be about your cash flow. If you don't have income coming in, but you have debt going out, and the debt's going out to high interest, then if you're able to take back control of some of that and just flow that back to you, that wouldn't really change your cash flow at all. So, but I mean,
I know some people get the lump sum for retirement and then they use the lump sum to live off of, but that would have to be a very sizable amount of capital to work on. And there's some other, I know that Penny, you got some other comments in here. She says I had 2 BYOB consultants in Canada give me policies, but no follow-up or creative strategies. Yeah, we don't know who they are, of course, but the follow-up might be because maybe they didn't see a way to make a policy work, but that's not very professional, in my opinion, if they didn't follow up with you. I mean, at least close the loop.
Yeah.
But yeah, we'd have to know more and stuff. And obviously we have partners that work in Canada. We don't run out in Canada, but we have partners that do it. So it's just, we don't have enough information, I think, right now to understand what you got going on. And then her last question here is, how do we know what type of do we have the right policy? There's actually no simple answer to that question, really. The more knowledge you have, the more you use infinite banking, the more that you can answer that question. Obviously, I believe that this team here is going to give you the best policy possible, or our partners in Canada are going to give you the best policy possible that is specifically for infinite banking. But it's just doing your research on the people that are doing it for you.
Yeah, and I do have a link for Canadian, like a form. So you can actually go to, I'll put it in the chat right now too, but it's beyourownbank.com/IBCCA and like IBC Canada. And essentially what that is it's just a Google form. It's going to ask you some questions. And then based on where you are in Canada, they'll, place you with somebody that's in your same province.
And go Dodgers.
Yep. Sounds like, so what you're saying right here, it sounds like they are using the lump sum to pay for their expenses. But the question is that lump sum going to be there for the rest of your life, or do you have to have income at some point down the road because the lump sum is going to run out? So it's just, priorities, I guess I would say right there. And yes, the money's sitting in the account right now. There you go. Now, this is kind of an interesting comment, the second part of this one. She says, we want to invest and create a dividend. So this is just my personal opinion. I don't know if anybody else has a different one, but to me, the infinite banking is not about creating dividend for cash flow. That's really not what it's for. It can be later on down the road, but it takes many, many, many years, decades potentially, to get to the point where the dividends can be enough for income, but not right away, in my opinion. Not financial advice. Anyone else have thoughts on that one?
Well, unless you have Yenny's policy, I mean, he by my calculations, he made $109 in 2 days. So,
There you go.
yeah, but I believe there are a little bit more mature policies. Is that right, Craig?
Yeah, that one, 16 years old. I mean, it's with the dividend and that guaranteed cash value. I mean, I think last year grew over 30.
Yeah, and that was kind of to Brian's point too, right? The first thought that Nelson Nash has around infinite banking is think long range, think long term. So anything you're setting up for today, again, you'd want to look at where your cash flow is, how it's flowing in and out, how you're going to take care of that. It's really where you start assessing what is the best move for you. So.
And I would say she mentioned that she had 2 people that she talked to. Shop them until you find the one that's the right match for you. Don't feel like you can't go to the 3rd or the 4th, whatever it takes.
Yep.
I like the idea that she said she was taking her principal and going to put it to work so that she'll have the interest to spend instead of whittling down the principal.
Oh, she said, "Go Jays." Here we go. I'm not even getting to work out because I'm dedicated to staying up and watching the Dodgers. And on Monday, it was 6 hours plus 18 inning game. It's crazy.
You know who the farm team for the Jays are, right?
Well, I'm guessing you're going to tell me somewhere near you.
Buffalo Bisons.
There you go.
I agree with what you just said, Joe. That's actually one of my number one things that I've learned in the last few years is you want to keep your principal and you want to live off the interest. That's like the most life-changing stuff that I have learned and am partially applying and can't wait to fully apply.
That's my pillar 4 that I teach. Spend interest, not principal.
Mm-hmm. And there's only a few questions right now too, so get those questions in. Matt is saying, what would happen if we would hit a deep recession or depression with the plans or loans on a policy?
So I guess a follow-up question to this one is, are you referring to your income situation or the insurance company's situation, financial situation?
Yeah.
What financial situation are you asking about? Because in my opinion, the insurance companies are like a freaking a tanker ship going through a storm, right? They don't change. They keep on going through the storm. They don't care about a recession. They don't care about a depression. They're going to go right through the middle of it and not change course.
So one thing too, Matt, there's the insurance company and these loans and these policies are only 2% of their entire makeup. So that's with One America. 2% was going to loans and policies.
And that's out of a $30 billion portfolio, just so you get an idea of the scale. And so whether the loans are performing or not, I mean, different carriers treat that different ways based on their business model, but it doesn't really affect their overall performance. They all have plans to grow at a steady 8 to 9% year over year, and they have plans for the next 150 years. So like Joe said, like we believe very much in this. Why? Because all the companies we work with, all 5 carriers, all 5 large mutuals have been profitable every year, and they're all well over 100 years.
And, and I often say, I actually worked in the financial reporting area. I went through the audits of insurance companies for 30 years. And let me tell you, the review that goes on in insurance companies is something that you've never experienced unless you've been in there firsthand. We have internal audit teams, we have external audit teams, and it's 6 months of review before it's ever finished. They know and they plan so many years down the line that this is a little wave, like you guys are all saying.
And that's awesome to hear. And that sounds just so painful, Tess. It sounds so painful.
It was painful. Everyone else is going skiing. And I'm like, yeah, I'll see you June 1st because we file our audited statements June 1st. You file regulatory March 1st and you're audited June 1st.
Wow.
So they're very serious about those numbers.
Hope that helps, Matt. If you got more questions on top of that, let us know. Like we said, we're a little short in questions.
I'll actually add a little bit because I pulled up some slides from Craig. Remember when we kind of talked about why we can trust them?
Yeah.
I don't know how to screen share though on StreamYard, so I'll just read from it. But so what the insurance companies actually do with your money, and I'm reading from my slides, so if it sounds like I'm reading something, I am, but it's a boring but brilliant investment strategy. So when you pay your premium, the insurance company doesn't just gamble it in the stock market. Instead, they put it into long-term conservative assets. So bonds that have steady interest and predictable returns, mortgages, low-risk loans backed by real property. And at this point, Craig, you were telling me you were visiting Lafayette. You guys were driving around the city and they were saying, look at this building. We own this building. This building is rented out to other offices and stuff like that. And they put it in other conservative assets, so highly regulated, like Tess was saying, stable and designed to weather economic storms. And so like the quote is they're boring on purpose, and boring is beautiful when it comes to keeping promises.
And, it's fun to look at history and, for example, 1933, there was an event called the bank holiday. And it wasn't that all the bankers went out skiing. It's just that there was a freeze on the assets of the banks because there was such a run on money. But you look at some of these tough periods, the Great Depression and those different time periods, and then you look and see these insurance companies paid a dividend that year. Great Depression, World Wars. It's phenomenal. So I think, Matt's question was, what happens if bad times come? Well, I'm suspecting they're going to continue to pay dividends because they always have.
And Shona said something really interesting, but it's true in that when they look at the investments, every single year, every insurance company's investments are reviewed by something called the SVO, Security Valuations Office. And line by line, they look at every single one and rate them. And then you have to run them through like key performance indicators and ratios so that you can see that based on what they think you should be at, that even though you have these reserve dollars, they may discount it to keep you in line with what they expect the future to look like. So there's always adjustments being made. When we went through the 2008, we had something added to all of our financials in the ninth hour when we were trying to get financials out called OTTI, other than temporary impairment, because they thought, oh, you know what? How could this impact us a year down the line? So they're so far ahead of it, they made us stop our year-end process and redo every insurance company's financials to add in an additional reserve just in case.
Which is what we want to hear. I hope that makes everyone feel warm and fuzzy. You got people over engineering stuff. Like you can't break it, you can't redline it. It's gonna be, they got the reserves. I mean, another point on this is go look who the number one purchaser of whole life insurance is. It's going to be the banks with over $225 billion of this stuff. So
we had counseling for months after that.
Yeah. And Tess, I think the audits that you're speaking of and kind of what's behind the scenes is they have death benefit commitments to make.
Yes.
That's really, you peel all this stuff back. That's what these regulatory boards and the state commissioners and all that stuff are making sure is, can you pay the death benefit claims? And because that's why this stuff is sitting there.
Yeah, and that's why it's liquid and sitting there too, right, Craig? So it has to be paid out on a timely basis. So the insurance companies are sitting on tons of capital. So.
And we look at it two ways. And I know this kind of freaks some people out, but you got to hear out the reason why. We actually issue two sets of statements inside an insurance company. One is called the stat statement, which is statutory, which means that goes to the regulatory boards, that if we were to close our doors right now, they want to know that you're going to be able to pay everything that you've brought in premium on that is a policy. So that's a statutory statement. But as a business, you want to be a going concern. You want to know if you're going to be able to continue down and continue writing business into the future. So we actually issued two sets of statements. One that's GAAP, generally accepted accounting principles, going concern. And the other was what I spent most of my time on, stat, which is liquidation based. If we went today and stopped business, yes, we expect to pay the policy of that child that's 5 years old today.
100%. And I feel like we just keep talking about it, but you're right. They're making sure that death benefits can be claimed. You're talking about your cash value. Like if they're making sure that top dollar is there, the bottom dollar is definitely there. That's like as simple as it is.
Yeah, which is all that's all at risk to the insurance company, right? Because we haven't, until you get to 121 or whenever that contract ends, you haven't put in all that cash value. So the cash value you're borrowing, they already have. Everything else is what they're guaranteeing, even though you haven't got that far out yet or whatever, right? Like you haven't put that much in, is what I'm trying to say.
I love it. All right. Whatever this name
Anybody
is.
else want to turn their head for this one?
I know it. Okay, so next question is the idea to dump all my income into the policy and take out as needed for expenses?
Never heard that before. No, it's not.
That's what
it's kind of
you're
weird. If you study Nelson's the book, he actually talks about doing that, but it takes like decades to get to that point where the policies are spitting off enough dividends where you could do that. At the beginning, no, because if you dumped all your income into a policy, how do you access the cash value? It's via a loan. Loan should be paid back. So if you're borrowing from the policy to pay your expenses, where's the cash flow to pay the loan back? And additionally, do you pay interest on your general expenses right now? No. So why would you want to actually pay interest on those? And the last thing I'll mention here, and this is the way I kind of explain it, when it comes to banking, there's banking functions and banking transactions. That's the way I look at it personally. A transaction is paying for your gas, paying for clothing, utilities, expenses, like that kind of stuff. General day-to-day things, cash and a check, but your banking functions is the borrowing and lending of money. So with infinite banking, we're not talking about the general transactions, we're talking about the functions, which is borrowing and lending. So that's what we're replacing. So hope that makes sense.
Mm-hmm.
Yeah, and I'd kind of boil this down to kind of three main use cases that we talk about mainly is if you've got debts, you're paying high interest on these debts. Is there a better way to run that money through policy and then pay off debts? So debts would be one. Major purchases, how do you buy your cars? How do you finance all those major things that you do in life, college, vacations, taxes? And then, of course, the last one is, what is your investment strategy? And is there a way to bolt on another layer to that investment strategy before you go do that investment? So run money through the policy, put it in the investment, run the money back in. But paying expenses, it's just one of those things to me. There's so many other things you can benefit from before paying expenses. And then what if you were to create a system where you put money into the policy and then the policy went out to work in an investment and that investment paid for your expenses?
Yes, and Chris, that's Joe's gas station example, and Chris would just say, that's just lazy. You know, that's a lazy way of looking at your banking system, right? Go out and learn how to make, like Shauna was saying earlier, make your principal make interest so then you can spend that.
But when it comes to expenses too, I'd rather pay myself before paying that credit card bill. I'd rather pay myself before paying that car loan, because you're always going to be making dividends on that PUA that you're taking out to pay those bills also. So it depends on the situation. My pillars, the ones that I teach, are A, you have to be in control, or pay yourself first. B is you have to be in control. C is money not in motion does not make money, and D is spend interest, not principal, or spend interest, not principal.
Spend your principal.
That is what Joe always says, just so you know, Joe.
Yeah, that's what he says.
Yeah. Should have asked Joe before you told us.
Yeah.
What's next?
Next is Penny Lover saying, would it be helpful to use the calculator I came across, I believe, velocity calculators? And they were asking
for.
Yeah, just they need income.
Yeah,
and then they're getting out of debt.
Yeah, this is the same person that was saying they have no income and they got a lump sum and they're living off of it right now.
Yeah, velocity banking just requires it's velocity of money is really what it is, and that requires cash flow. So to do velocity banking, you need cash flow.
Okay. And then Damien, which Damien sent us at the office a really awesome box of stuffed animals and t-shirts from the Navy. He's out there on the ships from time to time. So thank you for that gift that you sent us. And he's saying, can you go over some of the features of the Vault program? And I think that'll kind of go into Penny Lover's, calculator type of a question.
Yeah, so the Damien, the Vault, and why we're putting that together, it's really for a long time we've been talking about all the things you can do with infinite banking, how you can pay off debts, you can do major purchases, you can manage your loans. When it comes down to it, and I'll take you back to when I first learned about this. I started funding my policy. I'm like, why in the world would I take a loan? That sounds like the dumbest thing ever. Why would I take money for my policy and then have to pay interest? So even 16 years ago when I started this, I didn't get it, but I started trying to figure it out. So think of the Vault as a operating system so that you can better manage your infinite banking system. You can track your loans. You can figure out what's the best way to do debt reduction, whether that's with infinite banking and velocity banking and putting all that together. We're starting to build out some other features around major purchase planning and investing, and so it's really just the operating system for your infinite banking system behind the scenes. So that's kind of what we've been building.
Craig,
He's downplaying it quite a bit. It's freaking amazing. It gives you, because like the one, and I talk about this all the time, but there's one guarantee in life. Anybody? You remember what it is? One guarantee.
You're gonna die.
Graduate.
Well, that some of us, I don't know. I don't know if we're all really from here. So I think some of us, but I say it's change. Change is the one guarantee. And, when I just had someone that executed her policy, her initial goal was to pay off debt. And then she decided as soon as the policy went in force, as soon as she was able to pull a loan, she got a tax bill she wasn't expecting. And so now she's wanting to make that the priority. So whether that is mathematically the best move, we can now show her. But then if that's what she wants to focus on and doesn't want to hand Uncle Sam a 10 grand check that hadn't run through her policy, then she can use that and she can adjust the plan. And you can see it in real time. So every time something changes, the Vault's able to run all the math, to do all the calculations, and then to show you, hey, this isn't the most efficient, but if it makes you feel better, here's how you do it. It kind of gives you all the math and all the situations you can think about. As curious as you can be, you can create it. And we can show you how with infinite banking. And I love, Craig, my favorite thing that I heard you say so far is, look, this is what everyone's doing. This is no plan. And this is how much interest you're going to pay to them, that you're just going to give away to somebody else. This is if you just use math. I can just give you this right now. Here's the math plan that saves you probably 50 months plus or more, like double the time. And look, if you put infinite banking on top of that, depending on how much you're capitalizing your system, it accelerates it that much faster. And now look how much interest you save. So no plan, math, or using IBC and taking control. It makes a really nice comparison.
Maybe you need to add a little quote in the Vault that says, if you fail to plan, you plan to fail.
Maybe so. And maybe we haven't talked to you. Yeah, and for now, it's a web-based application, and we've talked about an app. I don't know if we'll do an app just because, as I talked with Chris about, he's like, everybody's apped out. There's an app for everything. So I think for now, we're going to keep it web-based just due to some of the priorities we have. But who knows what the future holds? Could go to an app.
I love it. And yeah, my perception of it is it's the planning part. We always talk about what you can do with infinite banking. You can do this, you can do that. And that's just really creating the plan, which has been missing. And now it's not. This is our last question that we have so far. So definitely get some more in there. Joe is saying, if I make an $8,000 initial dump in, how long should my $550 premium deposit last? The paperwork we received makes it looks like I'll be paying it until my wife is 95 years old. Is that correct? Yes.
And that's a paid up too. So a lot of the ones we're running are going to run all the way out to 121 years. And so, I mean, the plan that you're looking at is a paid up plan at 95 years old.
And Sean, I was thinking about that webinar we did where
I know.
because it was like, what did we do? We jumped to when you were like 80 or something like that. And
Well, I had the same thought. And again, I always say, like, I had all of these same thoughts as you guys, and I work here. So, like, you guys think you hear this on Wednesdays. I would hear all this crap 9 to 5, Monday to Friday. And I would still think, like, am I today, like, at the time I was 32, I was like, I'm 32. I'm signing I'm scared of signing my 95-year-old self up for some bill. Because for some reason, when I think of myself that age, I think I'm not going to have any money to pay this freaking thing. So
let's stay here for a while. Keep going. I want to stay here for a while on this.
Okay, well, so like my first policy, the annual premium that I'll be paying when I'm 90 or whatever is like $2,300. And I'm pretty sure that when me and Craig did the math, that $2,300 that my 90-year-old self is going to put in is going to unlock, like, I don't know, what was it, like $50,000 or $60,000 in cash value. And I'm pretty sure that my 90-year-old self is going to love $2,300 real dollars, that if I had to borrow from my daughter in order to make that payment, I would, if I knew I could hand her her money right back and have the rest of that.
Well, you wouldn't even have to use your daughter's money. That was going to be my point.
Like, that's something that Craig taught me actually too.
What if we think, like, if we're bankers and we've been banking for decades and we don't think, hey, let's go ask our neighbors are pretty cool people. They seem to have a lot of cash flow. I wonder if I can get, $2,300 from Joe and Susie, and I'll offer them a 10% return, like a bridge loan, immediately. And I'm not going to tell them that I just made 600%, So now you're thinking like a bank and you're running Joe and Susie's money through your system. You're paying them money, so they like you more. They'll give you money again because you're good for it. And then you make 590%.
Yeah. And then even the flip side of this whole thing, this whole discussion, if Shauna doesn't want to pay that $2,300, she'll have enough dividends that the dividends can just pay for the policy, and she doesn't have to worry about it. Yeah. There's just so many options when you get to that point, because the policy's so efficient, generating so much cash, where if she wants to pay it, great. If she doesn't, that's great too. So there's so many different things she could do when she gets to that point.
Yeah. Craig, you said your policy is 16 years old, and in the last 2 days it made you $90. I'm pretty sure you'd be able to like it's just crazy, because you definitely think that, I don't know, for some reason it's scary to think about signing your old self up for these bills, but they're not that at all. And it takes time to figure that out. All right. Next question is, can you pay your annual premium up front and begin the withdrawing after 30 days?
Yes.
Yeah, but we're not withdrawing. There's a keyword here where withdrawing is not anything that we're doing. Yeah.
Yeah, you want a loan.
I always like to ask, when someone asks me this question, I always say, if you believe what I believe, the wealthy have more choices. Is that fair? And that goes to how you pay your mode of payment. You can pay it annually. If you want it growing right away and borrow right away, pay it annually. If you need to build it up over time, pay it monthly. You can do that as well. And then you take loans out quarterly. It really depends on your cash flow and what your current financial situation is.
Yeah, and the way I've always looked at this is during your pre-retirement years, you're using loans to finance things you need, invest, pay it back, and so it's all loans back and forth. And then once you get to, let's say, a retirement age and you want to use the policy for supplemental retirement income, that's where you might do withdrawals. And I've run the numbers many times where it's often more beneficial to do withdrawals to cost basis and then switch to loans. So during our working years and financing years and all those things, we're doing loans. And then at some point later in life, you might start doing some withdrawals. But we don't do those up front.
Sorry, I lost my tab. Okay.
Terry.
Yep, Terry is saying, so if you have a paid up at 65, what will be the time at payout when you're 65? Or do you just stop paying for the policy at 65?
All premiums.
Yeah, when you have a policy that's paid up at, pick a 10-year term or 20-year or paid up at 65, that just means your policy's paid up and you don't put any more premium in it. So it'll keep growing and growing and growing and growing and growing, but you're just not. It was structured to be fully paid up. All the insurance costs are done at 65, if that's what it is, paid up at 65.
Yeah, it still doesn't mature until age 100 or 121, just depending on when that was issued. All policies nowadays don't mature until age 121.
Yep.
All right, and then Matt is saying, can you go into the MEC 7?
Sure.
Jay, you want to talk about that MEC 7? It's your favorite thing. What is it? Tess, what's the MEC 7? What is a MEC?
It's something you don't want to do.
Unless you're doing
Payroll. It's hard, like you said, it's hard to explain, but it's you don't want to MEC, and it's that 7-page overview, but there's a lot to it.
Yeah. And this is what I do. I just say, look, the MEC is a set of guardrails that the IRS has on policies. So if we go back into the mid to late 80s, there were times where you could put in as much money in a policy as you want. That went on for about 2 years. Yeah, right.
86, 87.
Let's say that you're putting in all this money because you want to get this tax-free growth and tax-free death benefit. Cool, but the IRS came and put some guardrails around that, where for the amount of money that you're putting into the policy, there has to be a certain amount of death benefit, is the easy way I would describe it. If you go beyond those guidelines, then it becomes taxable. So
I actually looked it up real quick too, so I can.
What Craig said, historically, right? If you go back, I mean, we learned this when we went through the IBC practitioner program. But if you go back to like 1979, 85% of Americans believed in whole life. Like our grandparents believed in whole life. You fast forward to 1985, and 55% of Americans believed in whole life. What happened? That's a 30% swing in 6 years. Well, in 86 and 87, all the attorneys of the wealthiest families were saying, hey, go put your money in this thing that everyone else is saying is horrible. You know, that Ralph Nader, everyone screamed and they recreated, they started ULs and started all this stuff. Go put as much money as you can. And Uncle Sam was like, whoa, yo, what's happening? You can't do that. You can't dump millions of dollars that's going to grow tax-free away from me. Like, I need my cut. So then the IRS created, in 88, they created TAMRA. TAMRA created the MEC 7, right, or the IRS did. And that's the guidelines that Craig's talking about. That's a distance between your cash value and your death benefit that has to not look like an investment. And if you ever worry, I think as a team, you know, over the last decade plus, we've done 20,000 plus policies that are in force, I believe, as a team, something along those lines. And then we're not designing any of those to MEC. And the insurance companies that support infinite banking, they're going to tell you, like, hey, you've MEC the policy. This is what that means. This is the amount that we can return it to a non-MEC status. Do you want us to send you a check and return it to that, or are you good with how it is? So there's lots of guardrails and stops too. So.
All right, so I'm gonna keep going on it too, because I like to learn things, and I'm learning this right now. So, endowment is a word that I kind of didn't really know, so I looked that up, and it says it's an endowment is basically a savings plan inside of an insurance policy. So it says if you die, your family gets this money. But if you live to a certain date, which on our policies is 121 years, if you live to be 121 years old, I'm pretty sure they give you your money back. So at that time, you get your money back. So what happens is the IRS says, okay, this looks more like if you, the MEC rule is so that you don't overfund it. So somehow you get out more than you put in, if that makes sense to you guys. Because then it becomes an investment rather than insurance. And it is insurance.
Mm-hmm.
And the key is, if you feel a hand sliding in your pocket, you have a Mac. We try to.
I like that.
We sell pants that don't have any pockets in them.
Yes. And the 7-pay test measures whether the amount of premium paid into the policy within the first 7 years exceeds the level of premium needed in the policy. And so I guess if you stay below that, you're good.
Well, and it gets more complicated because they assign that to, if there's any material changes, then the 7-year changes. So it just gets really complicated. So I would just tell Matt, 1, we don't design MEC policies. 2, if you send too much money to the insurance company, they're going to send your money back with a letter saying, hey, do you want to MEC this thing? Then we will do it for you, but they give you a chance not to MEC it. You typically have some time to get your policy. Even if you did MEC it on accident, I think you have 30 days to unMEC it.
You do. You have 30 days according to the letters. They'd say, hey, give us a call here, email us here, and let us know you didn't mean to do that. So
yeah, 30 days from it being sent to you. So you also have to be a person that is reading.
Opens your mail.
Yeah. So it doesn't mean 30 days from the day you read it. Okay. I have a HELOC at 7.5%. Would it be beneficial to use some of the available credit to start a policy with a lump sum and then borrow against the policy to pay back the HELOC?
What are you going to do after the money goes into the HELOC? Are we going to pay off debt? Are we going to put it into an investment to use arbitrage and leverage? That would be a great idea if that was the case.
And what you aren't saying but are saying, though, is that you don't want to just use the HELOC to put it in a policy and then put it back in the HELOC. You want to use it for a reason.
Pillar 3, money not in motion does not make money.
And I think it kind of goes to some of the other questions I'm seeing in the chat as well. It's, whether it's Matt or Joe's questions or just some of the other questions. This really comes down to following the first law of wealth. You have to pay yourself first. And it's a respect thing. It's a love thing. It's a different relationship with yourself and with money. It's really understanding that if you're not able to pay yourself instead of everyone else first, stop being last in line for your money. If you're not able to do that first, then doing things like leveraging your HELOC and other things is a recipe for disaster. Because all of a sudden you're not paying yourself, you're already having bad financial habits, and now you're going to take on more risk unless you're working with Joe and he walks you through and make sure you understand it. You don't want to put yourself at risk, because we're really just changing one thing, and that's where you're storing the surplus money, which is savings. Thank you for my soapbox minute. I saw some nodding heads, Tess smiling, but that's every time I see some of the fear and the feeling like this is a bill, I get it. Like, we feel the same way. Like, Patty asked me till we hit the efficiency point. She said, do we really have to put all that money in there? It would be easier if we didn't. I'm like, yeah, but that's not the point. The point's to delay gratification, right? So.
Then Damien has a question. It probably is different depending on how your bank is set up, but will most banks allow you to do a $10,000 premium payment, or do you have to break it up due to bank limitations? Like, let's say you're making that large. I don't know. My bank account doesn't have those like limits.
Yeah, I've never seen that kind of limitations with the bank. The easiest way to make premium payments is going to be have the insurance company do an ACH withdrawal from your bank account, and there's not really limits like that on there. I mean, you have other options like sending a check directly to the insurance company or doing a wire transfer, and there's not really limits like that either. No, I'd say no.
I've never had a problem with any of my ACHs coming from the insurance company, and they're a lot more than 10,000.
He has a Navy, Federal, and USA. You probably just tell them that you're going to make that payment if you need to. Just you authorizing it, essentially.
And if you're wiring it, they can see where it's going.
And then
even with an ACH, they can. And both of those banks, I see people paying their premiums with both of those all the time. No issues there, unless you've somehow put up some kind of limits on your bank account specifically, where you've told them don't let any money go out when the transaction size is over this amount. Otherwise, no.
I love it. And then speaking of the Navy, there was a box of stuffed animals from Damien, which were like little teddy bears, and then a goat dressed in like a Navy uniform. And did you guys hear the goat Navy mascot story, or do you know about that? Okay. I learned about it from these because I was like, that's just a very interesting stuffed animal, a goat in a Navy costume. And so the origin story of this is the goat is the official mascot for the United States Naval Academy since 1893. And the story goes that Navy sailors often kept goats on ships for milk and as pets. And when one of the goats on board a ship died, the sailors preserved its skin and brought it to a football game against the Army to honor it, and the Navy won. And from then on, the goat became a good luck symbol. So it's called Bill the Goat.
We're learning all kinds of things today, Sean. I love it.
Well, I was wondering that. Damien, if I'm wrong, you let me know. But I definitely looked that up because I was like, interesting.
If it's not true, we're going to believe it is now because I like it.
I love that story. I have a friend who just retired after 30 years in the Navy, and she's never told me that story. So now I think I'll get her a goat for Christmas and see.
And then there's an Army-Navy prank tradition where the goats, the Army and Navy mascot heists, so sometimes unauthorized, is where they steal each other's mascots.
Now, Shauna, did you say they were mecking the goat?
I don't know what they were doing to it.
Yeah, that's what she said, Craig. They were mecking the goat.
Damien, war games are awesome.
All right, and that's it for our questions. We got about a couple minutes here.
And thank you for your service, Damien.
Mm-hmm. And he seriously sent like 10 stuffed animals to the office and a bunch of shirts.
We have stuffy conversations in prayer every day still, so it's fun. So you guys don't know what that means, but there's conversations. They have their own like little, they're asking for loans to build defense systems and all kinds of stuff. And the one gets mad with power, and so I always have to take it out of power because it just can't handle power. So we always have to make it a worker seal. He's got quite the attitude, some problems. So that is part of having more fun and remembering that is the best part of being a kid. So Brian's like, what are you talking about?
And shout out to Connor May's comment up there where he saw that NASCAR driver Kyle Busch, sounds like him and his family lost $8.5 million in IUL retirement setups that were just trash.
Yeah, go Google that, look that up. It's they invested over $10.4 million according to what I read, and lost $8.5 of that money, and so they have a lawsuit against one of the. It's a large mutual company, not one that supports infinite banking, but a large mutual company. You would all know it right away, and then the agent. So if something, and kind of the point here with Kyle Busch, I looked this up too. We're going to actually do an episode on this. But Kyle Busch is, I think, the top or the second most highest paid NASCAR driver, earning like $15 to $16 million a year. And so if he, who, is going to be getting he's probably super savvy with who he's got around him and who's taking care of his money and different things like that. If he's getting duped like this, and there's so many agents out there, hundreds of thousands that are licensed to push IULs. And if you look at all the regulatory things that have happened over the last couple of decades, if you look at what happened back in the 80s with universal life, and these just fail. Like when interest rates change, when the market shifts, they fail. They don't perform the way that they're built. They don't look like, you know, there's tons of challenges. Chris have the $10,000 IUL challenge out there, but this is a huge wake up call. I just had a woman say, hey, I don't want my whole life. I'm just going to keep putting money into my IULs. And she's in her late 60s. And I couldn't do anything to help her, you know, other than say, are you sure? Maybe you should watch this, maybe have a conversation around it, but do your research. Don't believe what we're saying. But when you see stuff like this and it's now in the mainstream, it's a big deal.
You know what's interesting about that challenge, Jason, is I've shared that with a number of people I've gotten into conversations with about IULs, and they were confident that they were going to take that 10,000. And I asked Chris every once in a while, like, you ever hear from this person or this person or this person? Because they said they're going to take your $10,000 on that IUL challenge. It's never happened. So
and I believe that's ego, Craig, right? I mean, when you make a mistake like that financially, it is one of those things where you're not able to pivot, because if you do, you have to say you're wrong, and then it really hurts.
Mm-hmm. Yeah.
Well, I get excited when these people are like, oh yeah, I've got plenty of clients. I can show you the proof that we can easily take that 10,000. I'm like, this is awesome. I'm excited for you.
You know, and that's kind of exciting too, because maybe that will be the thing that tips them to doing things differently.
You hope, because that's a energy transference. That's going from being in a forced place where you have shame and you have fear and guilt and worry and all the low vibration, and you shift to love. I mean, that's really the shift we're talking about when you go to control and you start paying yourself first. I mean, it sounds nuts, but it's really an act of love, and it's a higher elevation in your energy.
Yeah.
Start doing this.
I'm also just thinking about, like, just when you said ego, there's also confirmation bias, I think is what it's called, where, like, if people believe that IUL, like, especially the people who have IULs, they can go find something that confirms that they made the right choice in doing that. They can, like, if you, anything that you want to believe, it doesn't matter what the topic is, you can find something to support your belief. And so you have to be willing to question yourself. And that's the only way you're going to break out of that.
Yeah, it's I think it might be sunk cost bias that you're experiencing. Like, you've made a decision, you put so much money into it, now you're just like, I just hope it's going to get better. You know, it's like deciding I'm going to get this thing because I think it looks good on me, and then everyone's like, I don't know, man. I don't know. I just spent this much money. This is an expensive shirt. I'm going to keep rocking it.
You're going to keep rocking until someone tells you what you want to hear.
Exactly. Somebody will tell you.
All righty. With that said, I think we're good.
We did it again. Way to go. Do we have outro music, or are we just saying sayonara?
Oh, yeah. We can do the outro music.
All right. Thank you, everyone. Come back again next week. Send us your questions, ask us more questions, and we'll see you all again next time.